All right, traders, George here, and a little bit more for you on oil inventories. You could look at this as a continuation of the last video that I did under Day Trading Essentials, but really this concept here has no boundaries. It could be relevant for an ETF, a stock, it could be a futures equity, a futures commodity. It doesn't matter. The point that I want to make here is that the conventional quote-unquote wisdom is that price should go up if supply goes down, and everybody makes a beeline for the oil inventory reports for this concept. I learned about this in my first econ class that I ever took decades ago, and it's clearly irrelevant. For July, all right, 5 consecutive weekly oil inventory reports where inventories were down. That means we were down minus 3 million barrels, minus 2 million, minus 7 million, minus 4, minus 3, right? 5 consecutive declining inventory reports here, and prices down $9 on the nose. 106.09s down to 97.09s. All right, so whether or not the inventories are up or down is irrelevant to price. All that matters are what your plans are when price does X. If you're looking to day trade based off of that information, or you're looking to position trade off of it, it doesn't matter. Okay, it absolutely doesn't matter. All that matters is where price is and what your plans are when it makes a move over a key level. And that's why you want to think about two directions at any one time. What would it look like if it starts to move up? What would it look like if it starts to move down? Where would you see acceleration? Where's the likely first target, second target, ongoing? So if you only are focused in one direction, like a lot of gold traders, only focused to the long side, missing out the opportunity, not able to think in both directions because it goes against their programming, then you're going to miss a lot of trading opportunities, and you might be fighting the real larger scale trend of the market. If you're only looking to go long because those inventory reports are down here in oil, you're going to have a real rough time with that process. And if you think you finally made some money when it pops here, you give it all back again and again as we make new structure lows. Okay, 5 consecutive lower inventory reports for July, price at a new structure low, and not just a new structure low, $9 lower in a month. If you're new to oil, that's major. That's massive, okay? And the fact that oil is now trading below this very heavy commitment zone is another bearish nod to oil. Hopefully this, in combination with these other videos, will get all of you out there that are still thinking about fundamentals as being relevant to price as being 100% irrelevant, and all that truly matters is price in and of itself. The only reason price moves is because of the supply and demand of price. That's the only supply and demand that matters, and it's the one that's never talked about. Maybe it's because a lot of people don't know that, but now you do, and now you can start to see price in a much more clear fashion. Don't make a supposition about where price should go based on a story. Think about if-then around key price points, and think about two directions all the time. What would it look like if we started to bounce here? Where might we find resistance? If we break down here, where are we likely to go? Ongoing, right? That creates the trade setup. That's the true lesson in supply and demand right there, folks. It's all about price, not about the story. All right, we'll see you back in the live room.